You found something we all agree on, emerging market debt.
Covered bonds and emerging market debts. We do barbell.
Yes.
It's probably not, actually maybe not a bad idea.
But despite all kind of talking about independence here and so on, is there any real alternative to US bonds from the US? Because everyone is looking, of course, for alternatives, but already mentioned it's the biggest market, it's the market everyone looks at the morning to. So is there any alternative, any real alternative?
I mean, we're not invested much in the US, no? I mean, we have 500 billion, maybe whatever, 30, 40 billion in dollar fixed, less than that in dollar fixed income. And
always, or did you reduce?
Always, because I mean, our people don't like. I mean, you know, they have some U.S. stocks, but they don't like U.S. bonds. No, so it's a really minor part of our business. Yeah. If you look at central banks, you know, international reserves amount to $13 trillion, and interestingly enough, they've been stagnant for 5-6 years now. The central banks, you know, although we had rising nominal GDP. The central banks of the world have not been increasing their international reserves, at least not their, you know, non-gold reserves. What they have been increasing is gold, yeah, but not non-gold reserves. And there, the share of the dollar assets is 58%. Now, it has been 73% a while back. It went down to 58%, and I think it will slide further, maybe to 50% in 5 years' time. So I think there is a very, very slow de-dollarization taking place. No.
I think what is important is to bear in mind where you are domicilized. So if you are a euro investor and you want to avoid the currency risk, I think most of the US assets on a hedge basis doesn't look very attractive currently. So,
but we talked about it right at the beginning. Asian clients are looking at European credit, but it's very much a marginal allocation because they've never had it before. Now they're, okay, maybe we'll put a little bit in there, but the US...
That means there's only upside.
True, but I think there's upside for the next couple of years. The US, nothing will ever replace the US. It's the deepest, the most liquid. Yeah, obviously, domestic retail are always, whatever country you're in, always going to be focused on their home currency market because that's just where the flows go. You know, you're going to euro-based investing, going to buy euros, sterling, dollar, etc. US can buy dollars, but it's hard to see for large global institutions, large global asset owners, particularly those in places like Asia where the local market is so small. It's always going to be a dollar market.
I just think it's, you know, it's too much of a good thing. Yeah,
maybe.
I think that the world is overexposed to dollars. Yeah,
it's just no. I totally agree with that. It's just what else do they buy?
Yeah.
What would you say? Kind of.
German covered bonds.
maybe we'll go market it. We should do a collective marketing of covered bonds around Asia.
So treasuries are still kind of a safe haven asset?
I think we can discuss...
It's a yes or no question.
I wouldn't say that, but I think we can still discuss about, for instance, our duration position or duration outlook on the treasuries, but not definitely a big underweighting of US treasuries. I would say that I think the same argument that speaks for European corporate bonds also speaks for the US ones, especially if you prefer the IG space. But again, I think it's a process that is going to take place. The dollarization I'm talking about, that is going to happen slowly. And not from day one to the next.
So we like actually emerging markets. Local currency, yes, but also from a hard currency perspective, it's tight. But with this, if the basis of the thesis is the dollar de-dollarization or the weaker dollar, I think it lifts quite some boats, right? I mean, you had only outflows over the last few years. It has now stopped. So there's definitely not any over allocation. You see the weak dollar, stronger currencies. I mean, they are reducing the fiscal debt, the debt situation. You have a rating upgrades. You have, especially if you're thinking about LATAM, you have the situation that the next election cycle actually shifts from the left to the right. So more fiscal conservatism. So this all, I think, is like a virtuous. So we think it's like a virtuous cycle. where without any doubt the stuff is tight, but we do see it actually as attractive against, if you think about DM sovereigns.
But can I ask a question on it? You were a bit conservative on the Fed outlook, so assumed the Fed wouldn't cut at all. Wouldn't that be a hindrance for further performance of emerging markets?
Short term, yes, because if you get the repricing, you probably won't see the weaker dollar in the first instance. But then again, you still have then the election cycle that actually shifts on fiscal conservatism. You have, I think if you're Columbia, right, you're shifting from left to right, left to righting cycle. You're getting much better on your strong currency, on your inflation stuff. You can cut rates. So if you think about EM local, I mean, we are not talking about the long end stuff, right? It's just like you want probably to receive the front end. They have so high really is. So we do think that actually this is something. It's tight, but people are definitely not over allocated to it. Not at all, actually. So this is some, even if we are cautious on spreads and only would stay selected names at the front end, we think that the attractiveness of these more niche markets is very good going forward.
I think it's more of a rates trade in emerging market local currency debt, you know. China has been a major disinflationary force for the world economy for the past 20 years or so, but is no longer a disinflationary force in the US because they're not letting the goods in. They put all the tariffs on it. So now all the Chinese stuff is flowing into emerging markets, you know. I've just been to Malaysia, and the Chinese car makers, they've destroyed the Malaysian automobile industry in a matter of 2-3 years, no? So they're just flooding Malaysia with cheap cars. And you see, you know, disinflation in many emerging market countries, which is driven by imports from China. So, for example, in South Africa, you had 11% yields in the local market now earlier this year, went down to whatever, 8.5 or so. In Brazil, you got 15% overnight rate. So I think there's a lot of many countries out there which still have relatively tight monetary policies, and they can cut rates.
No, I agree. And especially you mentioned South Africa, you have some emerging markets where you still have the rating upgrade potential, like South Africa or Morocco.
Yeah, Morocco. It's a great story, I think. Yeah.
Colombia, Chile, Brazil. So when I'm talking about low currency, I mean you're receiving 2-year swaps, something like that, right? You're not sitting on the long end. You don't need the spreads necessarily.
South Africa had a flattener, no? I mean, you can go long end.
In South Africa, we receive the long end.
Yeah.
You found something we all agree on. Emerging market debt.
Covered bonds and emerging market debts. We do barbell.
Yes.
It's probably not, actually maybe not a bad idea.
Yeah, no, you're right.
Emerging markets, a place to be for you as well?
I think I mentioned it in the beginning, we don't allocate that far for our institutional clients. But
we'll do it for you.
The question would be, and I think you kind of part answer that already with what you just said, but to me, I mean, emerging markets is a high beta. It's on the risk return spectrum. It's kind of in the northeast, so to speak. And can it really decouple when, you know, we get a risk-off scenario globally across spreads, risky assets? Because I mean, the risk is always there's tourists. I call them tourists going into these asset classes. They're in there, they don't fully understand them, and then, you know, something happens, and that'll probably be one of the first allocations that you would try and withdraw.
Yeah, but you know, most of the tourists have left. Most of the tourists have left.
That would be an argument.
Probably to AI and tech.
But if you say there's no tourists left, there's everyone that's in the market understands it and is there for very good reason. That's fine. But I'm just saying, if global allocators sitting in London, wherever, start putting money out there, that'd probably be one of the first areas where you would potentially bring it back, because it'll be difficult to explain potentially to your clients as well why you're in there, what you're doing there.